Today was the end of a quarter and obviously the final day of March. This is the monthly chart, and you can see on the monthly chart that we have a decent size bear bar closing near its low, but it's right at the moving average. What are the chances that April is going to have another bearish month? I think, if anything, if April does have a bearish month, I think it'll look something like this right here. So on February 28th of 22. Will sell off below the prior bar and probably form some kind of a doji. What do I think is going to happen? I think there's probably buyers below the bar, and April will be something disappointing for the bears. But that also means that April is probably going to be reasonably disappointing for the bulls as well. So, what do I mean by that? What I mean is we'll probably get a bad buy signal bar on the following bar if it is a buy signal bar. So what do I think is most likely? I think sideways. Not a strong sell to close bar. Bulls that bought the low of the prior month in February and bought more lower, I suspect they're probably going to be able to avoid a loss and make money. I do think we're long term, we're probably going to test down to the breakout point over here from January 31st. And at some point, I think we'll get to 5,000. Is this going to be the sell off? So is the high of the year, really the high of December is the high of this move. So is December going to be the high of the sell-off that leads to a test of 5,000? Maybe, but if it does, I suspect there's going to be a lot of sideways trading. What are the chances we get down here to 4,000? I think we need something really strong for that to happen. At some point, I think we will, but to assume that this is going to be the sell-off, probably not. We're at 5,500. We'll probably get down here over the next several months. Several months could be 2 years. It's very possible we spend a lot of time going sideways. So next month, we're probably going to see something disappointing. Daily chart. We can see that the daily chart had a bull reversal bar today. And I mentioned on the blog, if you read it, that we had a decent gap down on the open of today. And because of that gap being relatively big and the market being fairly climactic, I thought that increased the probability that there were probably going to be buyers below the March 31st low. This sell-off, as good as this sell-off is from March 25th, raise this desk a little bit, as good as that sell-off is, it's relatively, let me say it differently, the risk is big for the bears. And because of that, the risk is big. We had bad follow through March 27th. We have a very big climactic bar March 28th. That's a lot of a risk. And therefore, a lot of bears are going to be quick to buy back their shorts. And bulls, they're going to do the opposite. So I thought today had a reasonable high probability of putting in an early low of the day. So good bull bar for the bulls. What are the chances that there's buyers above? Well, one of the things I talked about on the blog was as good of a bar as today is, is today going to be similar to this bar right here, February 27th? I suspect that it's probably not. So in other words, there's probably sellers above today's bar, but there's probably buyers near the midpoint of the bar. And therefore, that makes me think that the bulls are probably going to get some kind of second leg. Realistically, probably a minor reversal. It's a micro channel from the March 25th high. Now, if tomorrow is another strong bull bar closing on its high, that would be a different story. But right now, I suspect sellers above, but I also expect buyers below. So if we trigger the buy above today's high, I suspect there's probably sellers somewhere above it, but there's also probably buyers somewhere below tomorrow's low. In other words, it's probably going to be some kind of bad low one. 5-minute chart. That's actually Apple. Oh, wrong screen here. Turn on the bar number. There we go. 5-minute chart. Today, Make these bars a little bit more spaced out. That's probably good. Coming into today, we formed a fairly big gap down. This gap 61.10 to 55.60. So that's about 50 points of a gap down. It's pretty big, especially with all the selling we've had over the past 5 trading days. And that increased the probability that there's probably going to be some kind of buyers on the open. So as far as one, as good as bar one looks today, it's strong enough that we may get a second leg down, but I suspect we're probably going to try and get some kind of opening reversal. And then we rallied on two, but one is strong enough that there's probably sellers above two. What is two telling us? Not a lot of bears are all that desperate to sell down here. And if a lot of bears are not desperate to sell down here, what does that increase the probability of? That increases the chances that today is going to probably form an opening reversal. If bears are not desperate to sell when the market's far below the average price, such as here, we're probably going to have to get closer to the average price. Bear bar closing on its low, 3. A second leg down after 1. Relatively big bar with big risk. In this case, can you sell the close of 3? I would not. We had bad follow through on 2. Plus, if you look at a Globex chart, this kind of hard to see. This right here, let me put up a 30-minute chart, it'll be easier to see. So this current sell-off we're getting on the Globex chart right here, this is this right here. And so at bar 3, this bar, the low of the Globex, is actually a relatively big bar, and it's a bear breakout below a bear channel. That increases the chances that it's going to be something disappointing today. This is not the same as yesterday, or excuse me, Friday. Friday went sideways for a few bars and we sold off, but the difference on Friday is right here. So this is here's the open of Friday. We have a tight trading range. And you can see we had a bear channel, tight trading range. We broke far below the channel. Probably not going to happen today. So that's one of those kind of higher time frame context cues you can use to better understand what is likely to happen today. 3, bear bar, probably going to get bad follow through. Bull reversal bar. 4, not a strong bull bar, but always in bears. Where's their theoretical stop? It's probably somewhere above 1. And if just ask yourself, what's the probability we're going above 1? It's probably pretty high. And because of that, I don't think a lot of traders are going to be all that interested in risking 30 points from the high of bar 4 to the high of 1. In that case, that increases the risk that there might be more traders buying the close of 4 or above 4. Always in bears, I think it's okay for the bears to get out. 5, strong reversal bar for the bulls. Do you see what happened on the low of 5 and the close of 3? All the bears who sold the close of 3, disappointed with 4, what are they doing? They're buying back shorts at the low of 3, at the close of 3 during bar 5, and that's a sign that we're going to get a second leg. Strong enough reversal, probably buy the close and buy the pullback. 6, bull bar closing on its high. What about selling below 6, betting on a double top with 1? I would not. It's a 3-bar bear micro channel, and if anything, there's probably buyers below 6. On some time frame, 6 is just a pullback from the rally above 4, and therefore 6 might be a better buy the close than a sell the close. 7, bull bar closing under the high of 6 slightly lowers the probability for the bulls, but now you have a 4-bar bull micro channel, tails above 6, tails above 7, increases the odds that we may pull back for a bar or two. But what about selling the first reversal down? No, we hadn't even had a bear bar, and the bears who sold here and scaled in, they're trapped, and that increases the risk that we may get a pullback. But as far as looking to do anything, the only thing I would be interested in is buying. 8, bull bar closing above 7, good for the bulls, but a little bit climactic. We have a tail on 6, tail on 7, and now we're getting a bull breakout above 8. That's a bull breakout of a bull channel. The channel began on 6 and 7, and we're breaking out of the channel 8. That increases the odds that 9 may pull back or go sideways. 9 pullback bar, but not a good buy above 9, and not a great sell below 9 either, and therefore probably buyers below 9 scaling in lower. 10 bear bar closing on its low, good for the bears, testing near the bottom of 6. What about selling the close of 10? No, it's just one bear bar closing on its low, and we have a bad sell signal bar below 9. I mentioned that 6 and 7 was the start of a channel, and therefore channels typically evolve into trading ranges, and therefore we may sell off to the bottom of 6 and find buyers. And then what does 11 tell us? 11 tells us that all the bears, when they look at the bears who sold the close of 10, are sufficiently disappointed with 11. If you're a bear and you're selling the close of 10, you're probably thinking to yourself, wow, what a good bar. We're going to sell off to the low of 3 or even the low of 4 and get a second leg down after the gap. But when you see a doji like 11, that's going to make traders question their premise. If you're a bull and you see bar 10, you're disappointed and you're thinking to yourself, is this a pullback or is this a successful reversal? And therefore, when you see the close of 11, you're thinking to yourself, yeah, I don't know, maybe I would exit my longs if 11 looked like 10. But I think the bears probably need one more good bear bar closing on its low. And 11, they didn't get it. So what does that increase the risk of? It increases the risk of 2 legs down. First leg, 9, pull back on 9. Second leg, 10 and 11. 10 and 11 are strong enough that there might be sellers above 11 and we get another leg down. But the bears, they really need to do more down here. 12, bear bar. Is that enough for one more bar? Not really. That increases the odds that there might be more traders buying below 12. Bears, they were happy to sell the close of 10, hoping 11 would be a strong follow through bar. And 11 is not a strong follow through bar. And that increases the chances that 12 is going to find buyers below it. And you can see, as soon as everybody saw the close of 12, what happened on 13? Traders instantly started buying. Why would traders buy? Because if you're a bull and you see a reversal in 9 and a reversal in 10, where's the best place to buy? Well, you're not necessarily going to buy the close of 10 because the odds are 10 is going to at least go sideways or get a second leg down. And therefore, the absolute best location that you could buy is right when you think the bears are just about to take control. We have a doji, and then we have this bear bar. It's almost enough for the bears to control the market. So if you think about it, we have a rally strong enough for a second leg. Bears, they're getting a reversal, increasing the odds of a trading range. But the bears realistically need more. And if you think about it, if you're a bull, it actually makes a lot of sense. If you buy the close of 11, you buy the close of 12, you could probably use a fairly small stop and you have more, and you can probably get more than twice your risk. And that's why traders will do that. It's also really close to 50%. So bulls, they see a rally and they see the market getting very close to 50%. What are those bulls going to do? You have a lot of bulls buying, betting on a second leg. You also have bulls who got trapped out of the buy on the close of 5. They looked at 5 and they said, yeah, it's a big bar. I want to see the follow through. And you see what happened? The close of bar 5 is 58 and a quarter, and the low of 12 is 59 and a quarter. Another way to think about that is most of the time, breakouts get retested, and you'll have some bears, they'll sell the close of 5 or scale in, and they're trying to get out back at the 5 close. 12, again, not enough for the bears, and that's why 13 happened. 13, strong enough bull bar, we're probably going to get a second leg, but we had a micro channel from the 8 high to the 12 low, and that increases the chances that there might be more traders selling above 10, selling above 8, betting on a second leg down. If you're a bear, it sounds crazy, but you'll have some bears do exactly this. They sell the pullback above 12, betting that this is a 4-bar bear micro channel or a 5-bar bear micro channel, betting that it's strong enough for a second leg. It's not a great trade, but some traders will take it, and they'll put a stop, way up here, and they'll sell. And if it pulls back too far, what are they going to do? They're going to say, wow, I'm sufficiently disappointed on this trade. Maybe I should just get out, break even on the entire trade. So break even in between both of my entries. So somewhere around maybe a little bit above 55.70. And you see what happened? The market came really close to break even and couldn't quite get there. If you're a bull, what are you going to do? The bulls, they're going to look at bar 13 and think, "Wow, I didn't expect that. Maybe I should bet on a second leg." But because most of the time breakout bars get second legs, traders are going to look to buy the midpoint. Bears, what do they want? They want a failed breakout above the 8 high and a higher high major trend reversal. They want a bear trend line break. Well, let me say it differently. The bears, they want a double top bear flag and they want trend resumption down after the gap. Bulls, they see a second leg up after the rally to 8. So 13, strong enough for a second leg, probably buyers below 14. And you can see what happened. 15 formed a bull bar. For the bulls, or 15 formed a bear bar, closing just above the 14 low. For the bears, is 15, is there sellers below 15? I would not. You're getting right in that buy zone around the midpoint of 13. Also, think about what happened on 13, 14, and 15. The market rallied on 13 and it sold off on 14, so bulls are disappointed. And then the market rallied near the upper third of bar 14 during 15 and sold off on 15. So if 16 reverses up, what is that going to form? That's actually going to form a micro double bottom. The bears went down on 14 and up on 14 and 15. Now they're going down on 15, and therefore there's increased risk. We get a reversal up on 16. 16, bull reversal bar, good for the bulls, increases the odds we're going to get a second leg up. And then 17, second leg down after 14. 15, we may end up going sideways here, but I suspect we're probably going to go at least a little bit higher. 18, bull bar, not a good buy, not a good sell, but if I had to do anything, I suspect I'd be long stop below 12. 19, bull bar, closing above the bars in the tight trading range, increases the odds of a second leg. And then 20, we have a bear reversal bar. For the bears, they'll see it as a failed breakout of the flag. You can argue the bears will see this as a final flag. You can call it a triangle. What about selling below 20, bear bar closing on its low? Some traders will. They'll bet that it's a failed breakout and it's a final flag and a reversal bar. But think about the logic. You're selling near the breakout point of the 18 high, and look at the moving average. You're selling just above the moving average after a strong rally. Always in bulls, I think it's okay for the bulls to exit below the 20 low, but realistically, it's possible that we trigger the sell below 20 and then we reverse up. And then 21, the market rallied, so you can see what happened. The bulls that bought 19 or above 19, the bulls that bought above 18 on 19, they thought it was strong enough for a second leg up. They're sufficiently disappointed with 20. And what are they doing with 21? They're selling out of their longs. The bears, what about the bears? The bears who sold below 20, I suspect, are disappointed by their entry bar. 21's a bear bar, but it's not a relatively strong bear bar. It's kind of the opposite of, it's not a bar like 13. And because of that, even though 21's a bear bar, it may lead to disappointment and there might be more traders buying after 21. And that's what I was talking about with 22. 22, bull reversal bar, good for the bulls, middle of the tight trading range. Not high probability, but the bulls, in theory, some bulls sold out of longs below 20 and some of those bulls would buy the reversal up on 22 or buy above 22. 23, bull break out of the tight trading range, good for the bulls, probably going to get at least second leg up. And then 24, bear bar closing on its low. For the bears, is this another wedge top? 13, 20, 24? That's a little bit interesting. You had some bears who sold below 20 and they're using a wide stop and they sold more above 20. But 22 and 23 are pretty strong. And because of that, it's possible that 24 actually traps the bears into a bad trade. Bears, they're hopeful that it's another reversal bar. But you have to ask yourself, why are the bulls getting series of bull bars? They're getting a series of bull bars here, a big bull bar here, and they're also getting a series of bull bars here. So let's see what 25 is. Always in bears. Do they get out below 25? Some will. Others will stay long, maybe stop below 22. And you can see what happened with 26. If you're with what happened on 25, if you're a bear and you sold below 24, 25 triggered the sell below 24, started to go sideways, and now 25 starting to reverse up. So what does that tell you? It tells you that there's not a lot of desperate traders buying during 25. Or excuse me, there's not a lot of desperate bears selling out of longs and desperate bulls selling out of. There's not a lot of bears selling to go short below 24 and not a lot of bulls selling out of longs below 24. And that increases the odds that we're going to get a second leg up after 22, 23. 26, bull bar breaking out above the high one, bears selling the 25 high, betting on a second leg down after 24. They're trapped. So if you're a bear, you sell below 24, and then you look at this bar and you think, uh-oh, that's a problem. Maybe I'll just exit break even at the 24 low. Look what happened. It never let you out. But what if you're a bear and you sold below 20, and then you sold more below 24? What are you thinking about 25, 26? You're thinking, gee, this is a problem. The reality is it's possible that this is the start of a bull trend, and the bears are not making money below bars. And this may be the instance where they stop making money above bars. So I pay attention to things like this, open gaps. It's not all that clear. It's really a negative gap. It's not technically open. Theoretically, it's what you have to understand about gaps. Traders look at gaps and they think, well, this gap closed because the high of 20 and the low of 24 intersect, and therefore it's a gap. Well, that's true, but when I think of gaps, I really weigh gaps based on how easy was it for the bears to make money. And in this case, it really wasn't all that easy to make money selling above bars. If you sold above 21 or you sold above 20 or even 23 and you scaled in, you had a brief opportunity to avoid a loss or make money depending on where you entered on your scaling. But now the market's up here and now you don't have that same opportunity. And because you don't know how far the market could go, there's increased risk that bears buy back their shorts. Bulls, they see a small pullback, bull rally, and a reversal bar. They're hoping the market's going to go higher. Bear bar 27. But what do you notice? The context is getting worse and worse for the bears. We have reversal bar 24, consecutive bull bars 25, 26, and then we have a weaker reversal bar 27. That increases the risk that there might be more traders buying below 27 and buying the high of 25 on a retest of 27. And in this case, the bears could not even trigger the sell below 27. This is classic channel behavior. Every time you get a bull bar, the market pulls back and they start buying the bear bars. And that's because they're buying in the middle and bottom third of the channel. Doji 29. Again, bulls, they're not buying closes, they're not buying above bars, they're buying pullbacks. They're waiting for weak reversal bars and they're buying below the reversal. 30, bear bar closing near its low, possible wedge 24, 28, 30. Are there more buyers or sellers below 30? There's probably more. There's probably buyers below 29 low and the 30 low, scaling in lower. How far down can the bears, what point? Let me say it like this. There's probably buyers below scaling in lower. However, if you are scaling in lower, you probably need a pretty wide stop. How far can the market go? It could easily go to the 25 low. It's possible we go lower, but probably not likely. And you can see what happened with 31 reversal bar. So the bulls that bought either the close of 28 or the close of 29 or the low of 29, disappointed with 30, they had an opportunity to get out 31. 31, not a great high one buy, probably sellers above, and a small second leg down after 30. Plus, we have a wedge, 24, 27, 29, increases the risk of another leg. And then we have a little bit of a surprise on 32. 32, is it sell to close? No. If anything, you're probably more in the buy zone than the sell zone. It's possible that 33 is a big bear bar closing on its low. But when you think about it, if you're a bull, it makes actually a lot of sense. You have two legs down, 30 and 32, right at the moving average, testing the 24 low. So if you're a bull, what can you do? You'll have some bulls, they'll buy the close at 32, put a stop about a bar range below, betting that 33 is not going to be a bull bar. And then you'll have bears. Some bears are short. What are they going to do? If 33 is a bull bar, especially closing on its high, they'll exit. So look at 33. Is 33 a strong enough bear bar closing on its low for bears to sell? No. And if you're a bull, what are you thinking? Are you going to be desperate to sell out of your longs above 33 or on the close of 33? Probably not. Two legs down in a fairly tight bull channel, we may end up getting a bounce. And that's what happened with 34. 34, bull bar, reversal bar closing near a tie. Not a great buy signal bar 33, but bears who sold 33 scaling in higher, they'll see it as a 5 bar bear micro channel. If they sold and scaled in, 34 is certainly a problem for those bears, and that increases the odds that there might be more traders buying here and buying the retest of 33. 35, bear bar, but not a great sell below. Do you see what happened? If you're a bear and you sold the high of 33, you're disappointed with 34. Look at the 35 low, the high of 33, 92 and a quarter, the low of 35, 93.75. So there's an open gap. And then what do you think happened right there? All of those bears who sold 33 scaling in, they said, the heck with this. 35 is a bad stop entry sell. I better buy back my shorts. So what do you notice? We have a small gap here. We have a gap here. We're forming a gap here. That is the formula for a possible bull trend. I talked about it. I'm going to turn my screen off for a second because I want to show something really quick. I just got to find it on this other computer. I think this is worth mentioning. Here we go. Here we go. So higher time frame context. Typically, what do you notice about this? We had a bull trend from the open that lasted pretty much the whole day. What do you notice about today? You had a bull trend from the open that lasted all day. So what's the difference? The difference is higher time frame context. And I'll go back to where we were. I want to make this point. The higher time frame daily chart is at support, and therefore there's increased risk that there's increased chances that there's buyers somewhere. Let me say differently. The higher time frame context is at support on the open, and therefore the odds are it's probably going to reverse. And a reversal on a daily chart is a bull trend day on a smaller time frame, like a 5-minute. So here, higher time frame context, tight bull channel. We're getting a bull breakout. So a buy climax on this time frame. Look right here. This is the buy climax. Here is an example. Find the opposite really quick. Yeah, this is what I'm looking for. So last example. Here, we had a bull trend from the open. And look what happened. It actually formed a parabolic wedge, went sideways, and sold off. Why? This is a 60-minute chart of that same bull trend day. The market gapped up on the open, rallied, paused, got a second leg up, forming a possible double top on a 60-minute chart. And that's why we sold off. So what's the point? The point is higher time frame context can help you better be prepared for what the market may do. 37, not a good follow through far for the bulls, but 36 strong enough for a second leg. And you can see started spending a lot of time going sideways here. Bear breakout 42. Why are we getting the bear breakout? Because you had some bears here. They'll sell and scale in using a wide stop, betting they can get out break even. The bulls know that. And so what are the bulls going to do? The bulls are going to buy a pullback. If the bulls know that the bears selling above 33, scaling in, are probably going to be able to avoid a loss. If they scale in, they're probably going to be pretty quick to. They're going. If the bulls, let me explain it better. If the bears sell and scale in and have a high probability of avoiding loss, the bulls know that, and therefore the bulls are going to look to buy a pullback. Why would they look to buy a pullback? Because we're in a bull channel. And that's what happened with 42. 42, reversal bar. But I think the bears still need more. We're at the moving average. And so far, every time we've gone to the moving average over the past several bars, we found buyers. Reversal 43, good for the bulls. Probably going to get a second leg up. What about sellers above 43, betting that 42 is strong enough for a second leg? I don't know. I think it's pretty. I think if you're a bear, 43 is a bull bar in a bull trend. I think it's really dangerous to hold short above that bar. And you can see that's obviously why 44 bull bar closing on its high, closing above all the bars to the left. What about selling the high of 36? Well, the bears who sold the high of 24 and scaled in made money. The bears who sold the high of 29 scaling in made money. What if they sell the high of 36? So you have a bull bar and then 44 and then a weak doji 45, strong enough rally 43, 44, probably buyers below 45. But I suspect the risk for the bulls is that the bears will probably make money. The risk for the bears is this might be a trap and we may form an open gap. And you can see what happened. The bears were allowed to make money. Why did that happen? Because the market keeps rallying and bears keep making money. 46, bear bar closing on its low. Do you sell the close of 46? Is this going to be the first time that the market gets a strong sell off? It might, but so far, selling closes of big bear bars has not been all that profitable of a strategy today. And that makes me think that 47 is going to be disappointing. 47, disappointment bar. We went below the 43 low, good for the bears, but probably buyers below the 43 low. So if you're a bull, think about it like this. If you're a bull, if you bought the close of 44 and you put a stop below 43, you lost money. But if you bought the close of 44 and you put a stop way down here and you're willing to scale in on a deep pullback, what do you think is going to happen? If it's a bull trend day, you're probably going to make money. And then we got a reversal up 48. So for the bulls, fail breakout below 43. I suspect we're probably going to get back to the 45 low and the 44 close. Doji 49, bad low one, short for the bears, probably buyers below. And then we got a reversal bar on 50, followed by a sell off 51. You had some bulls who bought, scaling in, getting out, break even. 51, reversal bar, good for the bears. What about selling the low of 51? I would not. Bottom of a tight trading range, probably more buyers than sellers. And then 52, a bull bar. Not a strong bull bar, but it's a reversal up and two legs down and a second leg after 46, 47. So there might be more traders buying down here than selling. 53, reversal bar, good for the bulls, probably going to go at least a little bit higher. And then 54, a bear bar. Bears, they're trying their best to get a bear breakout of this trading range. We have a spike in channel. The channel is evolving into a trading range, making a breakout mode. But we keep getting strong. We keep getting a series of bull bars and only one bear bar. 54, you can call it a double top with 50 and 53. What about selling below it? Some bears will, but we could just as easily find buyers below 54. And you can see what happened. As soon as the bears triggered the sell below 54, the market reversed up. We're leaving the trapped bulls below 45 and 40. Strong enough reversal, 55. Breaking out of a tight trading range here, probably going to go at least a little bit higher. Follow through 56. And then 57, bear bar, probably buyers below. And that's what led to 58, reversal up. High one, breakout, pullback, buy. But after strong breakout and follow through, resetting the market cycle, I expect we're probably going to go at least a little bit higher. And you can see we basically just started to form a channel. For the bears, a wedge, 57, 59, 63. But the third leg, 60 to 63, has three consecutive bull bars. And it's a micro channel from the 56, 58 low to 63 high. Probably buyers below, even though the market sold off on 64. 64, strong enough surprise, we may get a small second leg, but I still think there's probably traders buying 63, scaling in lower, and I don't think they're shaking out yet. Bull bar, 65, reversing, 64. Good for the bulls, but we may have to fall below the 65 low. 64 is a bad buy signal bar. It's a bear bar, and there might be more traders selling above it. And that's what led to the second leg down, 66. 66, second leg down after the bear breakout, 64, but a possible double bottom, 64, 66. And if we get a bull reversal bar closing on its high, I think always in bears have to get out. Bull reversal bar, good for the bulls. probably going to get a second leg. And what's happening here? This kind of going back and forth here, but I think it's worth it. This is a strong surprise, and it's probably going to get a more credible second leg than this. This is the euro versus the dollar. Strong surprise. We have a second leg. We have basically a small second leg up in the form of a wedge to March 18th, and we have a sell off to March 26th. Is March 26th the sell off strong enough to undo all of this? I don't think so. And therefore, this makes me think that we may get a larger second leg. So, what does that mean here? It's kind of the same logic. We're getting a breakout. We're rallying, but the rally's not strong, so it's probably going to pull back. The bears try to get a pullback that forms a trading range, bottom, and then we get a reversal bar, 67. 67, probably, always in bulls. I think they can buy above it. Always in bears, I would not. And then we got follow through, 68. Good for the bulls. Probably buyers below and at least a second leg up. And then we got 69, a second leg up after 68 and 67. What about buying the close at 69? 69 is a little bit tricky. It's 3 legs up, 57, 63, and then 69. And 69 has 2 legs up, 67, pause, 68, second leg, 69. So if anything, there might be more traders selling the close of 69 rather than buying it. Are those traders selling? Are those bulls? Are those aggressive bears selling, betting on a pullback? There's probably some bears doing that, but I suspect it's a lot of bulls selling out of longs, taking partial profits. And then we have a doji, 70, not a good sell below, but not a good sell above, so we may get another leg down. And then the bulls, second leg up above 69. Probably going to start to go sideways here, but bears, obviously, they're not doing what they should be doing. And then 72, reversal bar, good for the bears. What do you do with 72? We'll look at every strong bear bar today and ask yourself, was it good to sell the close of the bar? And it wasn't ideal. Bar 10, it went sideways on 11, second leg down 12. Bar 32, it went a little bit lower, reversed. Bar 42, it triggered the sell and then reversed. 46 went a little bit lower, got a second leg here and got a higher low here and reversed. We sold off below 63 on 64, pulled back second leg. Bear bar 72. It's probably enough of a surprise that there's probably sellers above and we'll get a small second leg down, but I don't think we're going to get a big bear bar. And instead, 73, we reversed 72. But like I said, there might be more traders selling above 72. So at some point, bears will probably make money if they sell and scale in. And then we have a doji on 74, so not a lot of traders buying above 73. There might be more traders buying below 74, and we get at least a small second leg, and that's what happened with 75. But you can see 75, lots of traders taking profits up here, and that makes me think we'll probably get back to the 72 close. 76, 77, we came really close to 72, and then we finally reached it, basically reached it over here. So obviously, good day for the bulls. What's the chances that we get a measured move of this gap here? I think it's important, and therefore that does make me think that we'll probably, well, there you go, no surprise. So a measured move target from the low of 4 to the high of 45. You can just look at it. This high 45 and this low 56 is in between are 2 really strong bull bars, 55, 56, and that increases the odds that the bulls are going to get some kind of measured move from it. And what is that measured move target? 5,700. So when I look at this, that makes me think we're probably going to 5,700. The high of today, 56.72, really, not that far away. So if I had to pick, I think we'll probably go to 5,700 sometime tomorrow. Although we may have to pull back first. For stop entries, bull trend day, and therefore after you see this kind of a rally here, you can basically just buy above any bull bar and close your eyes and use a wide stop, and you're probably going to make money. But as far as realistic stop entries, some bears will sell below 1 during 3. I think that's really aggressive. I think a really just general rule of thumb for traders is you're really probably better off waiting for 6 to 12 bars before taking a trade. And that's because look right here, the rally up to 8. What happened if you waited for 12 bars? You basically got to buy in the exact same location as 5. So waiting typically does not hurt you all that much, and you avoid getting trapped in the opening reversals. But because of the big gap down and the context on the higher time frames, I thought the bulls had a greater probability of getting a swing trade on the open than the bears. So when you see bar 4, some bulls, if they're aggressive, they'll buy above 4 and maybe use some will use a wide stop, maybe the range from the high of 1 to the low of 4. Some bulls will buy above 4, use a wide stop, higher probability, buy above 5, stop below 5 or 4. And then where do the bears? If the bulls buy, where do the bulls have to get out? Getting out below 10 is one of those really tricky situations. It's kind of the middle of the road. And if you've listened to Al, you've heard him say numerous times, being in the middle, getting out below 10 is kind of like a skunk stop. And what I mean by that is you're in the middle of the road and you're bound to get killed or squished being in the middle of the road. That's why it's called a skunk stop. And the way you manage those kind of skunk stop exits is you got to be really, really fast to get back in. So when you look at a bar like 10 closing on its low, if you get out below the bar, you can't, you can, but it's really not ideal. You don't want to wait until a bar like 13 to re-enter because you're going to be getting in basically back at the top of the move. So how do you manage that? You get out, you get back in when the momentum starts to slow down. Most traders are not capable of doing that. And that's kind of one of those finesse things. But either way, if you get out below 10, maybe you buy as 13 starts to reverse up. Worst case, you buy more, you just buy above 13. And then where do the bulls get out? They can get out below 20. And it's one of those same things. They get out below 20 and they buy again above 21. Actually, I misspoke. They buy again above 22. Now, some traders, just like the bulls who get out here, they re-enter. Some bulls will get out below 20. And then when they see 21 go up and then start to reverse, but not close on its low, what are they going to do? A lot of those bulls are going to buy as 22 starts to reverse up instead of waiting for the close. Part of that also has to do with context. The day is likely to be a bull trend or at least a trading range day. Bulls, if they're long, they probably get out, maybe they get out below 30 or during 32, but then they buy again as price rallies on 34 or above 34. And then maybe they get out below 39, not all that easy. Or if they're smart, they get out above 40, but then they got to buy again above 43. And if you buy above 43 and you see 45, maybe, some traders get out below 46, others get out a couple of points below 45, maybe an average bar range below or 2 bar ranges below a 45. And then bulls, some buy above 48, others use a wide stop and scale in. If you buy above 48 and you see a small signal bar of 49 and then you see a reversal up on 50, I think you got to be really quick to either use a wide stop or be really quick to exit because the risk is 46, 47 gets a second leg. And then bulls, they can buy above. If you buy above 48 and you get stopped out below 51 or 52, what do? You buy again above 52. Or if you don't buy above 52, you wait for the reversal and buy above 53, but the buy never triggered until 55. Always in bulls, they buy 55, or they buy for any reason. And I don't think they have to get out in here. Some get out below 63. But again, it's kind of like one of those skunk stop minor reversals. If you get out below 63, you got to be willing to buy again because the odds are it's a minor reversal and it's going to fail. So bulls, they buy 67. And that's pretty much the rest of the day. Obviously there's more to the day, but as far as stop entries, that's a good amount. It generally, on a day like today, because of the context and the fact that it's likely to be a bullish day, when you start to see all these bull bars, it's typically better. The way you trade it is you wait. It's a bull channel, and it's fairly tight bull channels. And therefore, the way you trade it is you wait for the reversal attempt to happen, and then you wait for it to begin to fail, and then you fade the reversal. So when you wait for 30 to happen, and then you look for a second leg down, 32, 33, and then you start to look for the reversal up. For limit orders, I thought there's probably buyers below 1 scaling and lower, but you need a really wide stop, so not ideal. I thought buyers below 9, but because it's a parabolic wedge, 7, 6, 7, and 8, I thought we may get a couple of legs, sideways to down. Buyers below 9, but you also may have to buy around 50%. And then I thought buyers below 11, I thought buyers below 12, 13, I thought buyers below 14, and really, probably buyers below anywhere, even buyers on the 21 close if you understand the context. Buyers below 24, but higher probability, wait for the reversal, 25. Wait to see it be a weak bull bar, 25. Why is 24 a buy below? Well, it's a bear bar closing on its low. So why is it a buy below? Because of 22 and 23, and it's breaking out of a tight trading range. I thought buyers below 27, but it never triggered. And then I thought buyers below 32, scaling and lower on 33. And then all through here, just buy and scale in, but really, really tough to do. And then, I thought sellers above 36, 37, but with 43 and 44 closing on its high, and the fact that you're getting open gaps, I really would not. I would not take that trade. I'd rather wait for the market to stall like 45, and even then, I'd really rather only look to buy. And then I thought sellers above 47, but again, the problem is you're in bottom third of a trading range, and it's a fairly bullish day. So are you really going to sell above 47? No. The reality is there's probably the bulls buying can buy and scale in. So I think selling on a day like today is just really, really difficult. And then buyers below 57, buyers below 63, scaling and lower, and really just buyers on all the pullbacks. Buy the close, sell the close. Arguably buy the close 5, buy the close 6, and then the rest of this, it's really better buy the pullback. You can buy the close and scale in and make money. Buy the close, scale in, make money, but it's better if you can buy a pullback instead. And then over here, it's buy the close 55, buy the close 56. And then if you use a wide stop, especially if you can scale in, it makes things easier. Okay, question. I struggle too much. I use the other screen to read this. I struggle too much on bull trending trading range days. The reversals always have very good signal bars, and the breakouts usually always have pullbacks. That's because you're in a channel and not a breakout. Traders aren't buying, basically look at it like this: don't buy the close, buy the pullback. And if you think about it like that, it's exactly what traders are doing. Traders are waiting for the breakout, and because they know it's a channel, they know the odds are high it's going to pull back. And so instead of buying the close of the breakout bar, they wait for the reversal attempt. They don't buy the close of 23. They wait for the reversal attempt on 24. And once it starts to stall on 25, then they buy. They don't buy above 28, 2 or 3 leg. It's basically a third leg up. It's an inside bar. So it's a high one in a third leg. Leg 1, 24, leg 2, 27, leg 3, 28. Inside bars typically pull back. And therefore, there's an increased risk that there might be more traders selling up here. So don't buy above 28. Wait for the reversal attempt. And most reversals are two-legged, and that's why traders buy down here. It's also the bottom of a channel. That's a lot of information, what I just said. And that's more about finessing your entries. Realistically, I think it's just important if you really want to learn how to trade days like today, you just got to think about a higher time frame. And it's tough because even you look at a 15-minute chart. Let's just look at a day only chart. This is a 15-minute day only chart. And what do you notice? It's basically a really tight bull channel with lots of pullbacks. But if we go to a 30-minute chart, it's a micro channel, even with a lot of overlap. And then a 45-minute chart, now you have a micro channel. But that micro channel doesn't look all that strong. So what's my point? My point is what you have to understand is it's a tight bull channel here. It's a broader channel, but the channel is fairly tight. It's really hard for the bears to make money. And that increases the chances that traders will look to buy pullbacks. So that will, it's tough. And that'll make more sense the more you look at charts. But basically, it's small pullback trends. Lots of traders don't like small pullback trends because they're always trying to reverse, but the reversals don't go anywhere. And therefore, you start to get used to looking to buy the reversal attempts instead of buying the breakouts. Okay, can you highlight the best trades of the day and break down the price action around it? Yeah, I kind of did that. And basically, I thought the easiest trades, let me go over the easiest trades. I thought the easiest trade was probably buying above bar 5 or buying during bar 5. Why? Because the market gapped down on the open, and I thought the odds were we'd probably get to the moving average at a minimum. But other than that, obviously the buys are easier. So as far as the easiest buys, this, if you were around 55, 56, you can buy above 55, you can buy above 56, just put a stop below. It's a strong enough surprise in that it's resetting the leg count. It's basically resetting the market cycle. And because of that, that makes me think we're going to get we're going to get a more clear, some sort of clear measured move up. Okay, this is a good kind of ending question. I'm struggling as a scalper. I still feel like I'm struggling. Any advice on how to improve? Yeah, I have a strong premise and a strong belief that a if you're a scalper and you cannot swing trade profitably, you're not going to be a very good scalper. So why is that? I want you to really think for a second about why that is. And really what this ties into is I want everyone to think about why do we scalp? What's the benefit of being a scalper? A really good scalper is actually a really good swing trader. What do I mean by that? You see what I taught? If you really go back on this recording and really just go back on the recording and think about what I talked about. I started talking about all the little nuances going on. So here we have a bull micro channel. Al would say that's strong enough for a second leg. But I also talked about that 6, 7, and 8 is a parabolic wedge because 8 is a bull breakout of the bull channel. And therefore you expect two-legged pullbacks. When you're thinking about scalping, the reason you're struggling with scalping is because you're losing sight of the higher time frame context. The reason traders begin to scalp is they start to realize, I could buy the close of 8, but if it's probably going to pull back for a few legs, I don't want to buy the close of 8. I want to buy the pullback. I could buy the close of 12, but 13 is probably going to be bad follow through. So instead of buying the close of 12, what am I going to do? I'm going to buy a pullback, and et cetera, et cetera. So if you want to be a better scalper, I would invite you to be a better trend trader. Learn how to swing trade. Learn how to recognize what a strong breakout is and what a weak breakout is. So where do we go tomorrow? I think tomorrow's probably going to have bad follow through. Obviously there's always the potential that we get a big gap up. And if we do, that'll begin to increase the risk of something like this. So the bulls, they haven't lost sight of the goal. They want a double bottom below of March 13th and today's low. They want a strong reversal up and a break above the neckline March 25th. They know realistically probably not going to happen. So this will be important for traders so that's what traders will want to see. I think if I had to guess, what do I think is going to happen? I think it's going to be the opposite of what happened over here. We had a reversal bar March 26th here. So we had a reversal bar March 26th. And what happened with the follow through? Thursday formed a small follow through bar, but that was actually an important bar. Why? Look at Thursday, this doji right here. Who in their right mind is going to buy above that doji? Nobody. So that's what led to a sell off on Friday. We have a reversal bar here. If that reversal bar forms a weak, some sort of doji that's a really bad stop entry sell, what do you think is going to happen? There's going to be more traders buying below it. So you'll have some traders waiting to see what the follow through looks like. If it's a really big follow through bar, they'll buy and scale in. If it's a weak follow through bar, they'll buy the close or fade the low one. So this is like a perfect example. We have a wedge, low 1, 2, 3. We have a bull bar closing on its high. The market rallied and formed a low 1. But who in their right mind is going to sell below this low 1? Nobody. And you can see what happened on the very next day. We gapped up several points. But we'll obviously know what happens tomorrow after tomorrow's close. So, all right. Thanks everyone for tuning in. Hope everyone enjoyed this. And I really invite you. One of the things that really helped me out a lot studying now was I was in the trading room. And importantly, the reason I'm even bringing this up is I would take the recording and I would go back and really study what he was saying in the end of day reviews. I'm not telling you to join the trading room. You can, that's your decision to make. What I'm telling you is this is a YouTube video and therefore it's recorded and it's an hour long. So go back on the recording of this video and think about what could I do to become better. Trading is all about okay, this is the last thing I'll say, so I'll talk about this for a second. Trading, there's a lot of information, and therefore it's really, really important to not lose the big picture items. Those big picture items, what are they? The market's in a trend. Think about the market cycle. Understand trending behavior versus trading range behavior. Understand leg counting. Leg counting, extremely important. In a trading range, you get a bunch of minor reversals, and therefore leg counting is extremely important in a trading range. But in a really strong trend, no one cares about leg counting. So something like this, nobody cares about the leg count. It's a parabolic wedge. No, it's not. It's a strong breakout on a higher time frame. Sell and sell pullbacks. Even here, it's still more bullish than bearish. So if you're buying and scaling in, you're probably going to make money. So think on those two topics and think about major trend reversals. Very last thing I'll say, if you don't know how to trade major trend reversals effectively, if you're scalping because you can't swing trade successfully, there's your underlying issue. Learn how to swing trade, then you can be a good scalper. Traders want to scalp because it's fun. You can make a lot of points in a short period of time, but you can also lose a lot of points in a short period of time. And the worst thing traders start doing, they buy below one, scale in, make money. They sell, scale in, make money. And it works somewhat all through here. Even if, if they're fading breakouts, they don't make a lot of money. Maybe they break even on a day like today. But on this kind of day, they buy, they scale in. What happens? They blow their account. So really understand strong breakouts. All right. Hope everyone enjoyed this. Take care. And I will be in the trading room tomorrow. But I think so if you want to ask questions, join the trading room tomorrow. And I think I'll post the end of day review here on YouTube as well. But there will not be a live end of day review. It'll be a recording from the trading room. All right. Take it easy. Talk to everybody soon.